4 buy and hold forever stocks. Now we're going to explain throughout the episode why we have chosen these 4, and one of the main criteria that we're looking at is that they have to have outperformed the S&P over the last 10 years. As we can see, our first choice today, Visa stock, has significantly outperformed the S&P over the last 10-year period. Now, when we take a look at this company, over the last year, it is up around 10%. Over the last 10 years, around the 400% mark. And in today's market, it is trading in the midpoint of the 52-week range. It has had a pullback from the 52-week high of $291. And we also note a double buy rating from Seeking Alpha and Wall Street with a hold from Quant. Now, it does have a forward yield, which is on the lower end of 0.8%, but we'll explain why that is still very, very strong. And in terms of a forward P, around 27. Bear in mind the S&P right now is at 23, but as always, high quality companies do always deserve a premium, and we'll explain again why this is warranted in today's episode. The next thing we want to point out, other than the fact that it has outperformed the S&P, is that when we do take a look at their earnings, they have a very, very good track record. Over the last 4 quarters, as we can see, they have beaten management targets, and in fact, moving forwards, they are anticipating over the next 3 quarters, double-digit increase to the earnings per share year on year. And when we look to September 2025, we can clearly see that the forward P will come down if they hit their target to around 23.75, which isn't too far off the S&P currently. Now, in terms of this company and their more recent results, well, one thing I like, not only do they have different income streams, but look at this, double-digit growth year on year to the service, double-digit to the data processing, high single-digit to international transaction, and on top of that, not just increasing their top line, but look at their margins, 5 percentage point increase year on year to the operating side, 4 percentage point increase to the net profit. And as we're about to find out, they have some incredible metrics. This really has to be one that you should consider for a buy and hold forever. In terms of dividend safety, it also gets a 99 very safe score. That is the highest score obtainable. And we also note in the more recent increase to their dividend, it was double digits at 16% in October. Now, ultimately, this is the highest score obtainable, and what it means is that the dividend cut is highly unlikely. Now, we always like to have a quick look at previous recessionary metric, and what this shows us that in the Great Recession 07-09, they increased the dividend and they also had plus 10% recession sales. That is well above the average of the S&P that came in at negative 12. Dividend growth, again, another reason why we love this and why you may think that it is okay. It doesn't have the largest yield because over the last 10 years and pretty consistently, they have been increasing that dividend by double digits. This is a strong dividend growth company, and they've been increasing those dividends for the last 15 years. And we would be very surprised if they don't continue this double digits moving forwards over the longer term. Now, on this channel, what we like to do is have a quick snapshot of dividend yield theory. It states a company is undervalued when the current yield sits above the 5-year average. So that is our first signal of undervaluation. Another signal, given the forward P, 25.4, is below the 5-year average of 28.8. So a double undervaluation signal. Although whilst we note the sector P does sit much lower at 11.9, there are a lot of poor quality companies within this bracket, and therefore we do believe it does deserve that premium. Then when we take a look at the free cash flow payout, we want to see below 60% as our blanket rule, and it's very easy to see why, how this company can continue to increase those dividends at a double-digit rate, 19% in 2023, so a lot of room to continually increase it very high, making shareholders very happy. In terms of the free cash flow per share, this is one metric we want you to keep an eye on throughout the episode. We want companies that increase it year on year consistently, and that is what Visa have done. In fact, from 266, they have pretty much quadrupled it to 962 in 23 and expected to continue that upward trend over the next 12 months. In terms of sales growth, well, 3 to 7% when we do our deep dives, they've pretty much got nearly double digit every single year. And we always have to point out 2020 was that COVID year, so no surprises of that 5% drop. And numerically speaking, we can see very strong, nearly tripled their top line over the last 10 years. And on top of all of this, with those double-digit increases, they also return excess cash through those share buybacks, and they are pretty consistent. Maybe not a massive amount every year, but still that is an added bonus to shareholders for Visa. ROIC, another very important metric. We want companies with a minimum of 10% year on year. That gives us faith that management are able to effectively allocate their capital, and Visa, no issues whatsoever, very high consistently. 34% in the more recent year does give us that faith that management are very strong in this company. And when we look at margins, probably one of our favorite metrics for Visa, both operating and free cash flow incredibly high, above 12% for most companies. They're at 64% in 2014, and we can note that operational efficiency increasing to 67% over the last few years. And on the free cash flow margin side, absolutely phenomenal, a pure free cash flow machine in the low 60s just over the last few years. The final metric we like to look at before valuation is the net debt to EBITDA, the earnings before interest, tax, depreciation, amortization. Below 3 for the majority of companies, and those numbers that you see below reflect the number of years it would take the company to pay off all of their debt net of cash on hand, effectively showing us that it wouldn't take them that long in 2023 to pay it all off, and this correlates to both balance sheet strength and dividend safety, so very, very strong for this company. A lot of metrics that we really do like. Now, when we do look at the intrinsic value, not every single one of these will be massively undervalued, and we will run through our price targets and margin of safety. Now, on this channel, we do run through every single one of these models when we do our deep dive. In today's episode, we're getting straight into the intrinsic value at $323. Now, with the current price at $265, we do always put in a margin of safety. At 10%, we do execute on companies if they meet our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. At 10%, if you believe that for Visa, a buy up to $291. Then we keep going till it's near the current trading price. It isn't at a 20% MOS level just yet, but in today's episode, for such a high quality company, we see 15 to 20% as an MOS based on our estimates and judgments, with Wall Street indicating 19% upside, their target price $317. This is definitely one to consider for your own portfolio in today's market, given the margin of safety and the nice upside for such a good quality company. But as always, let us know your thoughts as we do go along today. Now, before we move on to the next stock, just to let you know, we've released our latest free weekly article. The next one is dropping tomorrow, and if you do sign up on the pinned comment below, you get free instant access to all of these other articles that you can take away and take a look. 18 undervalued dividend kings also comes with a spreadsheet running through all the undervalued kings that we see in our price targets. And for paid subscribers, along with the free weekly article dropping tomorrow, you will get access to our analysis of growth stocks, 55 of them, and whether we believe them to be overvalued, undervalued, and what our upside target is. Moving on to the next buy and hold forever, we have the Home Depot. Now, this is one up 14% over the last 12 months. But as we said, every single one of these will have significantly outperformed the S&P, up 349%. It is trading in the mid to upper end of the 52-week range. A buy rating from Wall Street with a double hold from the other analysts, a forward yield that does sit higher than Visa at 2.5, with a forward P at 24, not far off the S&P itself. Now, when we take a look at their earnings, again, very good management confidence with the last 4 quarters beating analyst targets. And when we do look to January 2026, that forward P, if they hit it, will come down to around 22.43. Bear in mind, you could argue cyclicality of this industry. Next quarter, they are anticipating low-digit negative growth, but then when we can see over the subsequent 3 quarters, it is anticipated to turn positive. Now, when we take a look at the Home Depot, as always, revenue is going to be one of our key metrics, and we can see the consistency year on year. They have been increasing that top line. As always, that is one of the things that we want to see from companies, not just increasing top line, but also, I guess, increasing their margins. The Home Depot also score a very safe dividend score at 87, with their latest increase this year, high single digit at 7.7. Now, in terms of the last recession, well, they actually maintained the dividend. They didn't increase it, but they also didn't cut it. They had average growth at negative 11%, and they marginally beat the S&P, negative 44, with the S&P returning negative 55. Dividend growth also very nice, as we mentioned, this year's increase, but over the last 5 and the last 20 years, they have been increasing it by double digits, and in fact, they've been increasing the dividend for the last 15 years, whilst paying a dividend for the last 36 without a reduction. In terms of dividend yield theory, well, we actually for today get Home Depot at a reasonable valuation, yield not far from the 5-year average, and the forward P marginally higher than the 5-year rolling of 21.8. When we do look though, the consumer discretionary does sit significantly lower at 13.9. Now, in terms of free cash flow payout, whilst we want to see below 60%, it is a little bit higher than Visa, but pretty much below that every single year, bar 2023. 47% in 24 does still look very healthy. Then we move on to the free cash flow per share. As we can see, it has been growing over longer term. A little bit of inconsistency on a year-on-year basis. Nonetheless, the trend is looking very strong. Then when we look at the sales growth, we have to point out in the more recent year, in fact their first year where they had negative growth, but prior to that it still does look very healthy in that 3 to 7% range, some years a lot better than others. Numerically speaking as well, they have nearly doubled their top line over the last 10 years. Now on top of that nice dividend, they also do a lot of share buybacks. We can see reducing from 1.35 billion in 2015 down to around 997 million on a trailing 12-month basis. So that is a big part of positive news that shareholders do get to see when they are invested in this company. ROIC, I mean, consistently phenomenal, 39%. In fact, this year, one of their lowest years, does tell you a story in itself. So that is a strong indicator, especially for those investors who are either considering adding or considering a new position. Operating margin as well, whilst it does straddle around the 12%, it is still above that, 14% looking healthy. And on a free cash flow margin, 12% in 2024, even before that every single year, well above the 5% and pure consistency throughout. We then move on to the final metric, the net debt to EBITDA, and it is below 3, which is good because that is what we ultimately want to see as a maximum. 1.84 in 2024, no worries with their balance sheet, and again, makes sense why we do see that very safe dividend score. In terms of the valuation, now do remember you can grab a copy of this model by clicking on the pinned comment below. The intrinsic value at $385 doesn't give us a massive amount of margin of safety in today's episode. It just has around 5%, which typically we really hold that for companies that we do see at very, very high quality and that do trade typically at a premium. Now, whether or not you believe that is correct for Home Depot, that is up to you in your own investment decisions. But when we take a look at a 10% MOS level, it is a buy at $347, and those waiting at 15%, $327. Now remember, not all of these companies are going to be exceedingly undervalued. Like with Visa, that is one that we do see as a buy now. But these are companies that we do believe should be on the radar as buy and hold forever, especially when they are on a dip. So 15% MOS, $327. And we also know Wall Street do see upside of 6%. Their price target, $386. Again, not dissimilar from our own calculations. We then move on to Microsoft, where we actually have a strong buy from Wall Street, a buy from Seeking Alpha, and a hold from Quant. It is trading at the upper end of the 52-week range and has suffered from a small pullback over the last few weeks. In terms of dividend yield, well, 0.7%. Forward P sitting around 37, but as we will come to see, the forward P just in general on average does sit around 30. Over the last 12 months, well, up 23%. Over the last 10 years, significant outperform of the S&P, up 882%. Now, one of the things that we do like with Microsoft, it isn't talked about a lot, but they aren't just selling office products. They do have a wide range of income streams, and you could argue it is a little bit like a mini ETF. In fact, their gaming business alone brings in around 15.4 billion. Analyze their earnings per share, no surprises, they continually beat on a quarter-by-quarter basis, and over the next 4 quarters, they are anticipating somewhere between high single-digit to double-digit growth, and over the next few years, they are anticipating it to drop to just below 33 if they can hit those EPS estimates. Then when we look at the dividend safety, no surprises, another very safe score, double-digit increase in September last year. That is something that is pretty consistent with them over the longer term. And when we look at the key metrics, another one similar to Home Depot, they didn't increase the dividend, they didn't cut it either, they just maintained it, average growth, and again marginally outperformed the S&P. In terms of dividend growth, as we mentioned, consistently double-digit increases year on year. In fact, 19% over the last 20 years is absolutely phenomenal, and they've been increasing this over the last 13. When we look at dividend yield theory, it does look to be overvalued both on a yield basis as well as the forward P. And when we look at the sector, 26.7, again, a lot of these companies that we do deem to be high quality do deserve to be traded at a premium. When we look at the free cash flow payout, below 60% consistently, 34 in the more recent year. And when we focus on the free cash flow, very important metric, more than doubled over the last 10 years, expected to continue over the next 12 months. Sales growth pretty strong, no surprises there, nearly double digit every single year. The more recent year was one of the lowest at 7%, although we can see on a trailing 12-month basis, 14% does look very good. In terms of numericals, well then we can see in fact more than doubled over the last 10 years. And whilst they do share buybacks, it isn't a consistent thing every single year. Some years it is fairly trivial in comparison to other years. We then talk about the ROIC. Now every single company that we like that is high quality will have very high numbers, so no surprises here, 31% in 2023. And one thing that we always like to remind you with companies, don't just look at increasing revenue, but also focus on increasing margins, operating efficiency. something that Microsoft do very well, as we can see over the longer term, and another free cash flow machine, 28% just in the more recent period. Net debt to EBITDA will just goes to show you they have an incredible balance sheet over the last 10 years, not even one day to pay off all of their debt net of cash on hand. Over the next 12 months, it is expected to increase, but very minuscule. So this is a very strong company. In fact, they have globally one of the best balance sheets to show. Then when we get to the intrinsic value, $429, pretty much showing based on the current price, we do believe it is trading at its fair value. Now, a lot of people will be happy to just dollar cost average into companies like Microsoft that are very high quality. Some others will be happy with just a 5% margin of safety. That is around $408. At a 10% MOS, well, that is around $387. But as we can see in today's episode, pretty much trading at what we see around the fair value. In terms of Wall Street, though, they strongly disagree, and they believe the share price will go over to around $504 over the next year, upside of 16%. And as we said at the beginning of Microsoft analysis, they do consider this a strong buy. Do let us know, though, your thoughts below, whether in fact any of these as we're going along you are adding to, or maybe on the watch list at a lower price. We then move on to Costco, where we get a buy rating from Wall Street and a double hold, trading towards the upper end of the 52-week range with a very high current forward P at 52, although like some high quality companies, it is very rarely on sale. In terms of the forward yield at 0.55, and no surprises, over the last 10 years, significant outperformance of the S&P, up 704%. Now, what's interesting about Costco is that their membership numbers continue to increase on a year-on-year basis, and it only forms 2%, but they do bring in around $4.6 billion a year just in membership costs, and they have recently had a very small increase, which will help propel those numbers up again next year, and we can see continual increases to their top line. No surprises, a very high quality company, and one of the reasons it does trade at a significant premium is because investors do pay more for companies that are very consistent. Again, no surprise that over the last 4 quarters they have beaten, and over the next 4 there is a mix of mid-single digit increase anticipated to double digits. Now, even over August 25, when they are due to report next year, 17.78 on the EPS does still mean a very high forward P at 47.15. Again, no surprises, very safe dividend score at 99, double-digit increase just over the last few months at 14%. And when we do look at the essential metrics from the last recession, they actually increased the dividend. They had above average growth quite significantly, and they also outperformed the S&P -38. Now, not only do they continually have double-digit increases to their dividend, but they also offer special dividends every few years, with the more recent increase being in January this year of around $15 per share. In terms of dividend yield theory, no surprises though. We have here an overvaluation signal on the yield. We also note that forward P is significantly higher than the 5-year average of 36.1 and significantly higher than consumer staples 17.5. When we look at the free cash flow payout, well, what we note, 25% in 2023. No surprises, majority of companies that can offer those very high double-digit increases do have a very low free cash flow payout. And for those that are interested to know, we tend to ignore the earnings data as it is susceptible to manipulation by management through accounting, and free cash flow also helps us spot any potential dividend cuts inbound. In terms of the free cash flow, whilst we do have some sense here of inconsistency, it still increases over the longer term and is expected to over the next 12 months. Sales growth as well looking very healthy, 7% in the more recent year. The 2 years before that, we see some very strong double-digit growth to their top line, and they've more than doubled over the last 10 years. In terms of shares outstanding though, very minimal movement, very trivial, not something they are looking to do with their capital allocation. ROIC increasing over the longer term and very healthy. In fact, 29% on a trailing 12-month basis is very nice to report. One thing that we would mention, their margins are consistently very low. This is something very typical in these companies like Walmart and Target. You will see something fairly similar. And then the free cash flow margin, again, this isn't a company that the free cash flow margin is very high, but other metrics do look very strong in comparison. Net debt to EBITDA as well, 0 over the last few years and over the next 12 months expected. A phenomenal balance sheet, looking very good overall. And we also mentioned at the beginning, they have significantly outperformed the S&P over the last 10 years. Now, the intrinsic value at $823, and don't forget you can grab a copy of this model in the pinned comment below, does show that the current price is trading at a slight premium. So for those that do want to see at least a 5% margin of safety, you would have to wait for around $782. Again, that is if the share price comes that low. And for those that are interested at 10%, $741. Now, as always, we do see this trading roughly towards its current trading price, although a little bit higher, but Wall Street do believe this share price is going much higher over the next 12 months. Their price target, $911, they see upside of 8%, indicating that this is one to consider if you do want a high quality company in the portfolio. As always, let us know your thoughts about these buy and hold forever stocks. We had Visa, Home Depot, Microsoft, and Costco. Now, not all of them are going to be significantly undervalued. These are just ones that we want to highlight that when you do believe they are coming down to a price that you do believe is very good, this is ones that you should really consider to having a great high quality portfolio. As always though, let us know your thoughts below. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and we'll see you all on the next one.